Welcome back. Today we're going to be working on merchandising transactions. What we have worked on so far have really been the journal entries and income statements and such for really service-based industries. What you've been seeing so far has just been simply revenues or fees earned, whichever you will prefer to call them. Revenues, fees earned, and then we had subtracted from there. You had selling and administrative expenses. Can't find the other side of this. Okay, there we go. And from there it gave us income from operations. Well, that didn't work quite as well I wanted to, but our income from operations. All right, and from there you had a plus or minus other income, right? This is what you've been used to seeing. Let's see, plus or minus other income. This is what and after that it gives you net income. Okay, now this is the traditional basic income statement for a service-based company. But now that we're going to be working on merchandising companies, really you have to think about what is the biggest expense for a merchandising company. Now, if we step back for a second and we think about what a merchandising company is, a merchandising company would be those who basically sell other people's products. So Amazon, Walmart, Target, all of those are examples of merchandising type of companies. They're not really providing you a service necessarily, just a service. You actually are getting a good when you buy something from them. And they're also not necessarily manufacturing anything for you. Really what they're doing is reselling other people's things. All right? So with that, the biggest expense such a company would have would be the cost of purchasing the inventory that they are going to in turn resell to the customer. Okay, so for example, maybe we are Target and we buy a pair of jeans from $10 from Levi's, and we turn around and we sell that pair of jeans for $15, making $5 on the transaction. Okay, the expense in that transaction was really what we're going to refer to as cost of goods sold or cost of merchandise sold. All right, I tend to say cost of goods sold, but cost of goods sold, cost of merchandise sold can pretty much be used interchangeably. All right, so your income statement is going to change a little bit now. Your income statement is going to start off with sales revenue. And what you're going to subtract from there is, wow, these little things are hard to find. Okay, sales revenue minus cost of goods or merchandise sold. And from there you're going to have a new term. You're going to have your new term is going to be, oh, I hated doing that. Oh, there we go. Our new term is going to be gross profit or gross margin. It can be referred to also. But sales revenue, so as I was saying before, if you had bought a pair of jeans and sold it for $15, your sales revenue would be $15. Your cost of goods sold, because it cost you $10 to buy those jeans from Levi's, so you're going to subtract the $10, the cost of goods sold, oops, and okay, so it's not exactly lined up very well. Your gross profit is going to be $5. Okay, so that's what it's going to look like now. And the reason cost of goods sold is separated this way is because it is your biggest expense. If you're a merchandising company, your biggest expense is the cost of the inventory that you're going to sell. So it is preferred to look at it separately that way. All right, so you've got gross profit here. And now from gross profit, you're going to take away any selling and administrative expenses. Selling and admin expense. This is going to give you, again, another new category called income from operations or operating income. Income from operations. And from there, you're going to have your little category of plus or minus any other income items. And then you will finally have net income. Okay, so your service-based industry's income statement is going to look a little bit more like this, whereas your merchandising income statement is going to look more like this. Now this gross profit number, as I was saying, cost of goods sold is separated because it is the single biggest expense you're going to have on your income statement for a merchandising company. And it's going to give you this gross profit number. And that gross profit number is really important to identify. The reason it's so important to identify is because the selling and administrative expenses are basically every other expense of running your business. Depreciation expense, rent expense, wage expense, income tax expense, any expense that you can think of has to be covered by this gross profit. So ultimately what you're saying is this gross profit number has to be high enough that it can cover all of the rest of the costs of your business. So if you're running the business, it's pretty important for that number to be high enough in order to cover every other expense of your business and hopefully still wind up with a positive net income at the end of it. Okay. All right, sales journal entries. Let's start working with some of those new accounts that we're talking about. When you're selling something in a merchandising company, you're going to have a two-part journal entry for every sale that you have. Let's just say we're selling a product, and what we would receive when we sell a product would either be cash or accounts receivable, right? So if we're selling a product, say, worth $1,500, and to us it costs $1,000, let's just say. So the product we're selling, we would either have a debit to cash or accounts receivable, depending on whether or not they pay us right then and there. Oops. In the amount of $1,500, right? Because we're making the sale for that amount of money. So your debit would be to cash or accounts receivable. Let me make that an or. And your credit then would be to sales revenue for $1,500. Now there's another piece to this because you're recording the cash and the sales in that first part of the journal entry, but the second part of it is really where you're recording the inventory coming off of your shelves, right? So if you're selling a product worth $1,500, and to you it's worth $1,000, really you're making $500 on this sale, right? That goes without saying. But nowhere in here are you going to see a journal entry for $500. It's really going to be the net of these two journal entries that I'm going to do that is going to give you the profit of $500 on this sale. So the first part is recording the sale and the cash received or the accounts receivable as I've indicated here. And the second part of it is actually a debit to cost of merchandise sold or cost of goods sold, which going forward I'll probably just type in COGS, which is shorthand for cost of goods sold, for $1,000 because that's what it's worth to me. And my credit will be to my inventory for $1,000. All right, so let me tab that over a little bit more. There we go. So what I'm looking at here really is this first part shows the sale, and the second part shows the reduction of my inventory. Now if you remember back to the other statement, where I have sales revenue of $1,500 minus cost of goods sold of $1,000 will give me a gross profit of $500. So just to flip back over here, back to this, say I would have sales revenue of $1,500, my cost of goods sold would be $1,000, making my gross profit $500, and that's how they all work together. Okay, so we have this. Now there is another, that is whenever you have a sale of a product. Okay, it's always this two-part journal entry, and you've got to record the sale in one piece and the reduction of the inventory in the second piece. Now let's talk about some other accounts that are sales related. Let's first talk about sales discounts. All right, for those of you guys who may or may not have ever seen these terms, let's use these terms. We're going to put in 210 net 30, and that's how you say it. What this means here is this is a sales discount. These are terms that I have given to the people buying the products from me, because what I'm trying to do is I'm trying to entice them to pay me earlier. So what I'm offering here is I'm saying I will give you a 2% discount on your bill if you pay me within 10 days. If you don't pay us within 10 days, then I expect the full balance to be paid to me within 30 days. That's what this means. Now these could be any numbers. I could say 1/15 net 45, which would be a 1% discount if paid within 15 days, but no discount, and I expect to be paid in full in 45 days. Okay, so you can use really any numbers that you like here. I'm just going to stick with 210 net 30 to keep it simple. I believe it's also the one your book uses. Okay, so from here, let's say that they do pay us within the discount period. okay, meaning they've paid us in less than 10 days. My journal entry, let's see. My journal entry, if they pay me within the discount period, is they're going to pay me not $1,500, but they're going to pay me $1,500 minus a 2% discount. Okay, so what it is I have made a sale to some people for $1,500, and they're going to pay me less a 2% discount. So 2% on $1,500, bust out the calculators if you need to, would be $30. All right, so I'm offering them basically a $30 discount. So when they pay me, okay, in this case they didn't, we'll say that it's an account receivable, they didn't actually pay me yet. When they pay me, they're going to give me cash, not of $1,500, but they're going to give me cash of $1,470. Okay, that's net of the discount, of the 2% discount. So I've got a debit to cash of $1,470, but my credit has to be to account receivables, but in the full amount of $1,500. Now you may say, why is that? Well, let's see how easily I can draw a T account here. Here, I'll do it on a different screen. We'll do it on the trusty paint screen here. If I draw my little box, and I've got accounts receivable, and I would have had it in the amount of $1,500, right? Oops, it's hard to get that line straight. All right, I give up. All right, so you've got an accounts receivable, $1,500 in here. All right, now let's say we just credited it for the $1,470 they actually paid us, right? Because they paid us the $1,500 less the $30 discount. So let's say they paid us $1,470. Oop, I lost my line. What's that going to look like? Well, that's going to look like you have a $30 balance due. Now that customer is never going to pay you that $30. They gave you that $30 as a discount. So this $30, if we just record the cash, let me get back to this for a second. If we just record cash of $1,470 and account receivable of $1,470, it's going to look like they still owe us money, in which case they don't. All right, so we have to take the receivable off the books for the entire $1,500. All right, so this way you have no balance due. Oops, you're looking at my hair appointment. Or wait a second. All right, too many windows open. The other piece to make this transaction work would be sales discount of $30. That's going to be the other piece that's going to make this journal entry balance. So when you have a discount, you're going to go to the sales discount account of $30.